Greetings, Jonathan. Camarda with a rare midweek update, and had the fortune of having to listen, or I should say the pleasure of listening to Jerry Powell on Capitol Hill this morning. Won't get into details of that, except that he pretty much reiterated what he had said last week, except for the fact that you really can't stop thinking about the fact that even though they paused last week, he's giving more rationale of why they maybe shouldn't have paused, or certainly where they'll hike again in July without, again, with any specificity to that. So it is somewhat of a conundrum there. So let's go through what we're seeing. A few things here. You know, we have so much conflicting data. You know, if you look at the CPI, CPE data that they're looking at, and as such, even as they incline, but at slower rates, you have a lot of mixed signals. Now, a lot of times the Fed is using the labor market. Everyone's talking about the tight labor market, but as we've indicated on this show many times, that is a lagging indicator, which is one of the reasons when we're looking at inflation, we look at that site Trueflation, which actually takes into account the more leading indicators as well as a changed global economy. And, I don't know, knock, knock, Jerry, since COVID, supply chains globally have been changed, but yet they're using the same metrics that we were using before COVID. And that's why I like a site. Do your own homework, though. Look at Trueflation, look at the calibrations. If you have any comments, certainly let us know about it. But, we think that is the new zero grav 3D chessboard to look at as far as the true cost. That's in the mid-twos, almost close to where Jerry wants to get. Of course, the official number is 4. Okay, so as we look at that, there are some other conflicting signals we're seeing. If you look at new housing starts and permits, those are on the uprise. Has housing already gone through its recession? Like we said last year, we were going through some rolling recessions. It looks like housing is finding its footing. A lot of that has to do with the short supply and the demand, so new starts, but that is a positive indicator. And on the other hand, everyone talks about the economy being so strong, but we see the two, we usually don't talk individual stocks here, but these are not on those companies specifically, so just make a note there, compliance, is if you look at your FedEx, for example, coming out and talking about how they're going to be cutting people and to cut back on expenses, et cetera, that generally is not indicative of a extremely robust economy. So a lot of conflicting signals, not to mention we've had an inverted yield curve, right? That 2-year yield is still looking down steeply at the 10-year level, which is basically portending of a recession or going through a recession. Remember, rule 1 about recession, Fight Club, is that there is no recession until it's already happened. In other words, they always talk about recessions after they've occurred in the rearview mirror. Not that I've ever driven a race car, at least don't tell the policeman there, right? But I haven't driven a race car, but it's like a NASCAR or a Grand Prix. You look behind you, and that's when you see the wreck. Same thing with a recession from that standpoint. So a lot of conflicting data. As far as markets, as you can see, we're having almost a well-needed pullback. You see technology stocks, the NASDAQ, which have done extremely well this year, obviously off of very extreme lows last year, pulling back here, still well above their confirmed strong trend lines. Year to date, as we've talked about, technologies, discretionaries, communications, which we have good representation in, all still easily in the lead as we approach mid-year, year to date. Now, over the last month, you've seen a little, or last few weeks, last 5 days to 10 days, over the last couple of weeks, we're seeing a little more outperformance on staples and utilities. But again, those have done pretty much nothing this year. So that is just a slight rotation we've seen over a very short period of time. We'll continue to monitor. But again, as we look over the last several months, it is technologies, discretionaries, communications. Of course, over the last week, we've seen those resurgence on some of the staples and your energies. Those staples have really not been that conservative. Everyone says the staple companies, the ones I'm talking about. Defensive? Well, I don't know. A lot of them were negative this year after holding up decently last year. But again, you don't want to be stuck in the mud. And that's why we talk about continually having your head on a swivel and being tactical, obviously, especially in tax-deferred accounts. Now, as we look across the globe, currency-wise, the dollar continues to be down as it has all year versus essentially the euro, which is the primary currency we look, while being up versus the Japanese yen, which is more the beacon of safety, so that makes sense. But with a weaker dollar, which we continue to see under pressure, obviously that is still attractive for our large multinational companies exporting their goods. So that's why we continue to be overweighted in large caps.
With that being said, it's nice to see the small and mid caps finally get out of bed for the year. They've been outperforming large caps, it should be said, over the last few weeks. And generally, by the way, when that happens, that's actually portending of a growth cycle. And it's also good to see the widening of the breadth, as we've talking about before as well, right? More stocks, more companies, more sectors, like a foundation of a house widening to, again, give more strength to the upside. All the uptrends we've seen are all still in place. We've had a nice pullback. I say nice because it's, you need to have a pullback. The market doesn't do this and it doesn't do that. It generally does this, right? So kind of in a downward zag right now with all the trend lines in place. Seasonally strong time of year is coming up, generally the end of June into July. Believe it or not, the sell in May, people, that's a seasonally strong time of year. So we shall see if this short-term rotation continues. As always, again, if you have any questions, the idiosyncratic risk tolerances that you may have and how they correlate with the models that you're actually in, talk to your personal wealth advisor. And with that being said, I'm going to be dashing north from southwest to central to northeast Florida. And again, stay profitable is the theme. Have a great rest of your day. We'll stay eternally vigilant. And of course, it's what? Mid-June? Stay frosty. Take it easy.